Good afternoon, everyone, and welcome to today's webinar, Estate Planning Strategies for a Lasting Impact, presented by Episcopal Community Services. My name is Jessica Lynch, and I am the Senior Director of Development with ECS, and I'm so glad you could join us. We have a fantastic session ahead with valuable insights to help you make informed decisions about your estate plans. Before we begin, I'm just going to go over a few quick housekeeping items. If you'd like to engage with fellow attendees, let us know where you're zooming in from or even what parish you're with. Feel free to use that chat function. This session is being recorded and we will share the recording with all registrants after the event. Before we dive in, I'd like to especially welcome folks on the call who are new to ECS. For nearly 155 years, Episcopal Community Services have been working to challenge and reduce intergenerational poverty in the Philadelphia region. Through our programs, resources, and advocacy, we help individuals and families build pathways toward prosperity with a focus in West Philadelphia on economic mobility, health and wellness, housing stability, and more. While today's session is about estate planning broadly, we also encourage you to think about the impact you can have through charitable giving. Many individuals choose to support causes they care about as part of a lasting legacy. And organizations like ECS rely on that generosity to continue our mission. Whether through a future bequest or other form of charitable giving, your support can help create lasting change for families in poverty who are working toward financial stability and independence. With that, let's get started. It is my pleasure to introduce our guest speaker, attorney Emily Pickering. Emily is an accomplished estate planning attorney with the firm Morgan Lewis, where she advises individuals and families on estate and gift tax strategies, family business succession, and philanthropy. A recognized leader in her field, Emily has been featured in the Best Lawyers in America publication as a one to watch, as well as a Pennsylvania Super Lawyers Rising Star. Emily is a third-generation ECS supporter and volunteer. Her father, John, served on our board for over a decade, and her grandfather, the late Reverend Timothy Pickering, former rector of Church of the Redeemer in Bryn Mawr, also served on our board. Emily currently serves on the Advancement Committee of the Board of Trustees. She earned her undergraduate degree from Harvard and her law degree from Cornell University. Emily, thank you for being here.
Thank you so much, Jess, for that introduction. And everyone, I'm just so excited to be here. I love talking about estate planning. It's all that I do. And I think it's a really fascinating and interesting topic that frankly is relevant for everybody. So I hope that today, you'll enjoy sort of hearing some practical tips, some learning about the estate and Pennsylvania inheritance tax system. And also, as we go through the presentation, I'll kind of give you some tricks of the trade, and then also talk about how you can really maximize your charitable giving if that's something that you're interested in doing. So with no further ado, I'm just going to get started. So first, I think it's important to kind of talk about what we're going to talk about during the presentation, give you a roadmap. So first, we're going to talk about why you should do estate planning at all, which is a question that I get a lot and actually is really important just to understand why it's important. Second, we're going to talk about the federal estate tax system. You really can't talk about estate planning or understand why estate planning is important if you don't understand the federal estate tax system. It's essentially the backbone of all estate planning. We'll also talk about the Pennsylvania inheritance tax system. I'm assuming that a lot of people on this call are from Pennsylvania, and Pennsylvania actually has a very strange inheritance tax system. So we'll be talking about that and how it works. Then we'll be talking about charitable planning and estate planning during your lifetime, things that we see, things that we recommend. And lastly, we'll be talking about estate planning and charitable planning at death. So I hope that everyone will find something interesting to learn today. So the first question that we get a lot is why should I do estate planning? I don't want to. I don't want to talk about death. I don't want to talk about taxes. Sometimes people say, I don't think I'm ever gonna die. And I say, well, One thing I do know is that everyone's gonna die and the tax man is always gonna come. But when we're talking about, estate planning goals, what people think are important, it really comes down to five things. So first, it's preserving and enhancing wealth. And so for everyone, that can mean something a little bit different. Money when you die can go to basically in three buckets. One is people, so your family or people, other loved ones. The second is charity, always a good use of your resources. And the third bucket is the tax bucket. And something that pretty much everyone can agree on is that they don't want that much money to go to taxes when it could go to people that you love, or it could go to charity. So basically, the reason that I have a job is because I help minimize the tax bucket and maximize the other buckets. And also when they leave money to their family or to a loved one, they want to put that in a specific structure. We're going to talk about some of those today, or have that look a certain way to sort of maximize your family's ability to be, happy and healthy, protected from taxes, protected from creditors. So again, the second bucket, which relates heavily to the first bucket, is tax efficiency. So when we talk about tax efficiency, and we're going to talk about that during this presentation, we're talking about minimizing tax. So what can we do to increase the charity bucket, increase the people bucket, minimize the tax bucket? Another thing that's really important to people is enhancing creditor protection. So like I've worked very hard during my lifetime to earn this money. I want it to go to my descendants or go to my spouse. How can I protect them from creditors? And what can I do also to protect my money from creditors? That's a really important question that we get a lot of the time. Another option or thing to think about is how can I make my family beneficiary, really sort of productive members of society. So we talk about beneficiaries. That means people that are going to inherit the money after you die. If you're giving them a lot of money, sometimes it can be so much money that they could not work, or they could sort of do things that you don't want with the money. So how can we sort of put a structure in place that will help them be happy and healthy? Because honestly, if you don't have a happy and healthy family, doesn't matter how much money you have, it doesn't mean anything. So when I think about my job, I think of the main part of my job is to make families as happy and healthy and have good relationships with each other as possible. The last bucket, which is a bucket that I have a very big soft spot for, is providing for charitable giving. So I'm lucky enough at Morgan Lewis that we have clients who are very interested in giving a lot of money away. When those clients come here, I get to work with them and sort of my specialty. So something that people think about when they die is, how can I preserve my legacy? How can I sort of give this big gift that I've been thinking about giving during my lifetime? Like, how can I make an impact at lifetime or at death on my favorite charity? So we're going to be talking a lot about charitable giving today, because there's lots of good options in terms of giving money away in a tax efficient way. So I just wanted to review what happens when you don't have a will, because I think that one of the number one things that I hear is, well, I don't need a will because I'm married and I have kids and everything will go to my spouse when I die. But that's not exactly what does happen technically under the law. So I think it's important to talk about what happens if you don't have a will and you die. And that's called intestacy, is the word. So what happens when you die depends on state law, and it depends where you live. So if you live in Pennsylvania, it's called intestate law will govern. If you live in New Jersey, for example, New Jersey intestate law will govern. So what happens in Pennsylvania, I'm just going to use myself as an example. So I'm married and I have one kid. If I died, my spouse would get the first $30,000 of my own assets, and then he would get half of whatever was left. And my kid, who is 2, would get the other half. And this is not something that I would want to happen. And for the vast majority of people, they don't want that to happen, especially if your spouse is older and really needs that money to sort of live the rest of their lives. They're retired, they're dependent on the money that you have coming to them at your death. It's really important that this not happen. And it can be solved with literally a 2-page will can solve this issue. So if you take one thing from this presentation, I hope it's this: please get a will. You can even something off of the internet, although we're not really supposed to say this, is better than nothing. So just it's something to really consider when you're thinking about what to do for estate planning. Just get a will. It says everything goes to my spouse. If they're not around, it goes to my kids. Another really important thing to remember, and a thing that we see happen all the time when people are coming into our office, is that a will only governs assets in your own name. So if you have a joint account, for example, that will pass directly to the joint owner. It sort of bypasses the whole will. Retirement accounts, same thing. They're governed by who the beneficiary is on the retirement account. So if you name your sister, for example, before I was married, my sister was the beneficiary on all my accounts. If I died, she would get the money that was in those accounts. It wouldn't pass pursuant to my will. So I really encourage you to be very careful about who you designate on these accounts, the retirement accounts, especially because people just forget about them, frankly. A will only govern assets that are in your own name. And of course, you can also use a will to make a gift for your favorite charity, or do other sophisticated estate planning techniques, which we'll talk some about today. Because I love pictures, and I think pictures are easier to understand. At the bottom, I just put in a graphic so you could understand what would happen in the absence of a will. So on the left, we have the husband. He died intestate. So he died without a will. He has $1.03 million. The wife gets $530,000. And then the kids each get $250,000, which is not what we would want, split equally between the kids. And there is Pennsylvania inheritance tax. We're going to talk about that a couple of slides from now. They will owe 4.5% on anything that they have received from you. They get a very, very small, it's called a family exemption. It's only $3,000. So it does not go very far. Everything else is going to get taxed that goes to kids is taxed at a 4.5% rate in Pennsylvania. So next we're going to talk about the federal estate tax system, which people I think find very mysterious most of the time. I'm hoping that this will help demystify it somewhat. The federal estate tax system is extremely punishing, which is actually probably the reason that I have a job, is because the federal estate tax works the way that it does. And it's really important that you understand this part. So the federal transfer tax system is essentially three main taxes. The first is the gift tax. So that's when you make gifts during your life. There's a risk that there can be gift tax imposed on that transfer. The second is the estate tax. So that comes into play when assets are transferred at death. And the gift and the estate tax work together. So sometimes people say like they work together and the GST tax is separate. The generation skipping transfer tax is separate. We're not going to talk a lot about the GST tax today because it only comes up when you're making, or it typically comes up when you're making gifts to grandchildren directly. So it's called a skip because it skips over the child generation. It goes to the grandchildren. So for most people, it's not really that relevant, but it's important just to know that if you're not careful, you can sort of get this additional layer of tax attached to the gifts that you're giving to your family. Is something to be very careful about. So these taxes are imposed at a really, really high rate. There is a very high exemption. We're going to talk about that on the next slide. But if you are subject to the estate tax, you end up paying 40%, which is just huge, whopping tax. So it's really important, though, to understand that there are certain exemptions because the government doesn't really want to tax everyone on assets that they're leaving to their families. They understand that, they kind of pick a cutoff point where they say, okay, if your estate is under this amount, we're really not going to tax you. So right now, that exemption is huge. It's $13.99 million per person. It's never been this high. Even 10 years ago, it was like $5 million a person. In 2000, it was $1 million a person. So, and this was passed by Trump as part of his Tax Cuts and Jobs Act in 2016. He passed this bill that sort of allowed the exemptions to be this high. So right now, just as an example, if I died, I wasn't married, I left my child $14.99 million. The first 13.99 would be protected from taxes from the federal estate tax. The other million, the that was left over essentially, that would get taxed at 40%. So $400,000 tax. And for every additional million that I leave to my kid, it's an additional $400,000 of tax. So sometimes people call it like a cliff tax because you kind of go and you don't pay any tax, and then suddenly you fall off the cliff and you pay a lot of tax. So what happened was when Trump passed the Tax Cut and Jobs Act, it wasn't very popular that he increased the exemptions this much because people don't really have that much sympathy, as it turns out, for people who have like more than $10 million to pass on to their kids. So it's supposed to sunset at the end of this year, which is really, really important. And when it sunsets, it's going to be reduced by half. So when he originally passed it, it was $10 million. And then they're going to reduce it down to $5 million at the end of this year. But then they were going to index it for inflation. So although we don't know like exactly what the exemption amount is going to be at the end of this year, we're projecting it to be around $7 million, but nobody knows exactly what that's going to be. And of course, with President Trump now in office again, nobody's sure what he's going to do between now and December 31st either. So he's under a tremendous amount of pressure to produce a tax bill, to extend this cut. And we sort of are presuming right now that it will be extended, but we don't know exactly for sure. So an important thing to understand as part of this too, is that if you make a gift during your lifetime, a big gift, we'll talk about that a little bit later on, it will use up some of your gift and estate tax exemption. They're sort of linked. So if you have $13.99 million of exemption now, you make a gift tomorrow of $1 million. If I died on December 30th, I wouldn't be able to pass $13.99 million to my kid without tax. I'd be able to only pass on $12.99 million to my kid without tax. So to the extent that you use gift tax exemption during your lifetime, it affects how much estate tax exemption that you have at death, because otherwise it would effectively be like a double exemption. You have 13.99 during life, another 13.99 when you die. The IRS isn't like that. So if you have even a risk or thought that you're going to make a big gift, we should really suggest that you hire an attorney, that you talk to someone. There's tax filings that you need to do, gift tax returns that you need to file. It's just not something that you want to play around with. Like we've seen, unfortunately, like we have a reputation of being able to solve big problems created by other lawyers. You see that in our office all the time, like failure to file gift tax returns, failing to sort of do the reporting that you were supposed to can cause enormous problems later. So that's just something important that you should be thinking about. The GST tax exemption, just to mention it, is also 13.99 million. So it's the same, even though it's a totally different tax, the exemption amount is the same. And if you do set up a trust, you want that trust to be GST tax exempt so that no matter how many generations it goes down, it will always be exempt from tax. So, and you can only really do that by appropriately or properly by doing it on a gift tax return, is allocating GST exemption to a trust. So the IRS is not completely cruel, although they are cruel with this 40% rate. They do sort of give you some exclusions. So the gift tax exemption is called the exemption because you have a certain amount that you can use up. There's when we talk about exclusions, that's things that you can do like every year, every time, and it doesn't count against your exemptions at all. So this is sort of an important thing to remember for estate planning because it's actually a very valuable tool. So the first one is if you pay something directly to a school or to a medical institution, that does not use up gift tax. So we've had people here paying, $1 million in tuition a year for their grandchildren, does not count against their exemptions at all. You just have to be extremely careful that you write the check to the school. So sometimes people say, oh, my kid paid it, but I gave them a reimbursement check and that was fine. No, that's not fine. The IRS does not think that that's fine. It has to be directly to the school. But we always encourage when we're talking about planning, give it to pay your grandchildren's tuition, pay their healthcare costs if you want. It can be a significant way to sort of lower the amount that you have in your own estate that's subject to tax and pass on a benefit that pretty much everyone agrees is a good one, like health and education. And for the medical, you have to pay it again directly to the medical institution. So you have to pay the health insurance premiums directly. You have to pay the hospital bills directly. You can't do a reimbursement. The IRS also allows you to give a certain amount to a person every year, and we'll talk about this more on the next slide. And right now that's $19,000 a person. So you can give anyone $19,000 a year right now. It won't reduce your lifetime exemption amount. And over time, and if you have a bigger family, this can add up to be a lot of money. So you have some families who are able to shelter, $700,000 a year just using the annual exclusion amount. And the annual exclusion amount is in place because the IRS doesn't want people filing gift tax returns for giving like a Christmas gift or, I bought her like a nice bag. They don't want to be bothered with send things under a certain amount. So right now that's 19,000. It's been adjusted for inflation. It started off at being 10,000. The third one is a marital deduction. So the IRS wants to allow spouses to transfer assets between each other tax-free. So to the extent that you're passing something to your spouse, that will not use up any of your exemption. And that'll come up a little bit later. It's very important in the death context about money that's passing to your spouse. And the fourth, of course, is the IRS doesn't want to tax money that's going to charity. So money that's going to charity, again, is completely excluded from any of these taxes. So I always like this slide. We use this slide a lot. This is just an example. So again, we're talking about the $19,000 amount that you can give to a kid per year. And for married people, you each can give $19,000. So in this example, the husband and wife are each giving their each child $38,000. So $19,000 from the husband, $19,000 from the wife, adds up to $38,000. That together, that's $76,000 for just 2 kids. You can sort of transfer to your children tax-free. So as people get older and they have the flexibility to make bigger gifts, we start saying, well, why not just give your child, the $10,000, $15,000, if you can, $19,000 a year, to sort of lower the amount that's in your estate and be able to take advantage of this exclusion amount. This is kind of like a practice tip that we have. A lot of people say, this is amazing. I'm going to do this at Christmas. And that's actually like a terrible idea because the check has to be cashed and has to clear by the end of the year. So a lot of the times the kid wouldn't get around to it until the 31st and it wouldn't clear until the next year. If that happens, it doesn't count. And this is like a once a year thing. So if I did that in 2024, if I cashed it or I tried to deposit on the 31st, it didn't clear until the 2nd, it would count as a 2025 gift and not as a 2024 gift. So actually best practice is to do this in January. So you can make sure it gets done. And also obviously you can't give somebody an annual exclusion gift if you're dead. So if it's January and you're alive, we encourage people to write those checks to their kids. And I should say it goes beyond children, of course. So like friends or siblings that are in need, like this is a great way to kind of get some money to them each year. Okay, so now we're going to talk about the Pennsylvania inheritance tax, which is a very sort of special tax system that Pennsylvania has. It's called an inheritance tax because technically the people who are inheriting the money are supposed to pay it. The estate tax is paid by the giver. Inheritance tax is supposed to be paid by the givee, although pretty much every will that's drafted appropriately in Pennsylvania will say the giver will pay the inheritance tax as part of the gift. But that's why they're called different things. So Pennsylvania does not have a gift tax. This is a separate tax from the estate tax. It's imposed at death. Pennsylvania does have a clawback. So what they don't want is for you to think, okay, I just got really bad news from the doctor. I'm going to die in 3 months. Let me give everything away and I will avoid the Pennsylvania tax. They don't want you to be able to do that. So they have a look back where they say, okay, within 1 year of death, did you give anything away? And if you did, then they will tax it. What's very unusual about the Pennsylvania inheritance tax is that it's actually, the rate is dependent on the recipient. So for spouse and charity, it's a 0% tax rate. For descendants, so kids, grandkids, etc., it's 4.5%. But then it jumps. So for siblings, it's 12%, and for other people who are not siblings, it's 15%. So for people who do not have children or are not married, like this is actually can become like a pretty big number in terms of taxes that you would have to pay. So if your family looks like that, like if you're not married and you don't have children, we actually focus a lot more on things that we can do to mitigate this tax, which basically is trying to give things away during your lifetime as much as you possibly can, so that we can avoid it at death, and we can avoid it if you can avoid hopefully you dying within a year of the gift. They do, and how they kind of find it, because sometimes people ask us, well, like, how could they figure this out? How could they like determine gifts that I made during my lifetime? Is that they actually like look at bank statements going back a year, and they can see that you made gifts, and they will tax those. It's just something to be careful about. So now we're going to talk about charitable giving and estate planning during life, and what this looks like for most people, and also what we recommend that you do, and kind of common pitfalls to avoid. So one really important thing is correctly identifying a 501c3. So this is an issue that we see all the time. And just to kind of review, a 501c3 is an organization, it's called organized under Section 501c3 of the tax code. And it's a charity. Right? That's what we're talking about. It can't be for a private person or an individual. So sometimes people say, oh, well, there's this guy that I know in church and he really needs my help, so I'm going to give him a lot of money. You can't do it that way. It has to go to a charity. It can't go to a private individual. 501c3s can't legislate, so they can't influence legislation. But something that we see people do a lot of by mistake is incorrectly identify the 501c3, which can really be problematic, because what happens then, it leads to kind of a fight. So about who, they really meant to get the money and who they promised the money to versus the actual beneficiary that's listed in the document. So with a larger organization, what we see most is that a specific chapter or location thought that they were going to get the money, but then the person who was writing the will just said, the national organization, or didn't specify. So like a common example is like the American Red Cross. So there's like the American National Red Cross or Red Cross organizations, and there's a local organization. So I would just encourage you to be careful about when you're thinking through that. Do you want it to go to the national organization, or do you want to support the organization that's in your actual community? I would say vast majority of people would rather support the one in their own community versus the national organization. With a smaller organization, you just have to be really careful on the name of the organization, because if that is wrong, that can lead to some trouble down the road, where the people who's supposed to get the money says, well, I can't legally accept it because that's not the name of my organization. And then you have to go to court sometimes to actually figure that out. And it's very expensive. And frankly, in terms of mitigation strategies where you're trying to increase the buckets that you want to go to charity and family, literally nobody wants to spend money litigating where this money is supposed to go. Nobody is interested in that outcome. Another thing that we really encourage people to do is for all organizations, so no matter who you're giving the money to, focus on the financial health of the organization. Is this are they in a good, healthy place? Will it be here in 5 years when I think I might die, or 10 years, or even longer than that? And something that we do is that we check every charitable organization that people come in and they say, we want to give money to X. We look at their GuideStar, which is a website, and you have to set up a login, but it's free. And it will give you the tax reporting for that charity for years. And it's because the reporting requirements are so onerous for charities, you can actually see and learn quite a lot of information about the charities once you check their GuideStar report. So for every person who comes in who says, I want to leave money to X, we'll check that. And if it looks worrisome, and you usually can tell it looks worrisome because they have very little money or they're operating at a deficit, we'll say, digital is not being run very well. There seems to be some structural issues here, financial problems. Do you really want to give money to this organization? And sometimes I'll think about it. Occasionally, they've made like major gifts to kind of get that organization back on track at the time. But it just is something that you should think seriously about when you're thinking about making transfers to these organizations. Okay, so now we're going to talk a little bit about strategies in terms of transferring money to organizations that are more income tax based. So the reason that we focus on this or talk about this at all is that people often don't understand the differences between giving certain assets to charities and what that could mean for them in terms of their tax planning. So when we talk about this, we're going to go through a couple of different options. Just a word about what we would advise that you not give to organizations or maybe like as a last resort. So things that are very difficult for charities to deal with are things like real estate or artwork or things that are difficult to liquidate and require a lot of reporting and oversight from the IRS. We really encourage you to give cash or appreciated securities. We'll talk about the pros and cons of each of those versus these sort of like harder assets to give. You always can direct in your estate plan, for example, that an asset be sold and the proceeds donated to charity. So we see that from time to time, but we generally recommend that you think seriously about what you're actually trying to give away. So we're talking about cash here, although when my dad looked at this, he pointed out that like you're not really transferring cash, you're doing like a bank transfer. So, but cash I just used because it was a shorter word and it fit a little bit better on the page. But of course, like you can give cash to a 501c3 and everyone loves cash. So when you give cash to a 501c3, you're limited to deducting 60% of your adjusted gross income, which we call AGI. And that's a pretty generous we call it like a ceiling. And you'll see it's lower for other things that you give. So just for example, if you had $10 million of AGI in 2025, your charitable deduction limit for cash gifts is $6 million. And I put really big numbers in here just because it's easier to do the math or think things through, not because I think that anyone here has $10 million of AGI. If you do, that's fantastic, like amazing for you. But it was more just to kind of understand the math and how it works. If you give less than that, so if you give 5 million, you can fully deduct that. And if you give more than 6, you're capped at the 6 million for the deduction, but you can carry forward. So if you're planning on doing like a big gift where it actually is coming up against that limit, which is pretty rare for most people, just make sure that you are working with a professional accountant who can help you take into account the carry forward. This isn't something that TurboTax is going to be able to really help you with. Like you should have a professional person who's helping you with that. Another option is transferring appreciated securities. So just to kind of take a step back and talk about what those are. So appreciated securities are like stocks, for example, that you own where you bought them for a certain price and now they're worth more than that. Those are what appreciated securities are. So what you bought them for is called your basis. And then anything that you have sort of that's over that amount is the appreciation. So the IRS kind of understands that when you're giving appreciated securities away, you get certain other benefits. So they cap you at a 30% of AGI because they say, well, look, like you're already getting these other benefits of giving away an appreciated security. So we're not going to let you go up to 60% the way that we did with cash. We're going to cap you at 30. but there are some real benefits to it. So the biggest benefit is that it completely eliminates the capital gains tax, which is a very big deal. So if you have a security, you bought it for $1, it's now worth $100. You can give it away to charity, and the charity gets the $100 gift. They don't pay any capital gains tax. You don't pay any capital gains tax, and they have the benefit of having this $100 in their pocket. And it just completely eliminates the capital gains tax. It's really, when I'm talking about this too, we're really talking about like long-term appreciated securities, which means the securities that you held for more than a year. It also eliminates something called the net investment income tax, which isn't like a big number or that important, for purposes of this conversation, but just to understand that it kind of has this benefit of it effectively erases these very large tax bills that you could otherwise be paying through capital gains or the net. So when do we see people, using these? Generally, we see them with older donors who have had stock for a very long time that's very appreciated. We want to have them use our appreciated stock when they're giving money to a charity. Like that would always be our first stop. To say like, let's get rid of this, very large appreciation that you have in your portfolio. Let's give it to charity. Let's take the charitable deduction for it. Like this is great. That's sort of the most common thing. Or if you have something that has very rapidly increased in value. So we had this happen with like the Tesla stock, people who held really big positions in Tesla. They were trying to give it away because it was so volatile and the appreciation was so high that we encouraged them to give it away to charity. But usually what happens is that that's something that you decide on with your investment advisor. So your investment advisor says, look, like here's your most appreciated securities, like let's give these away. And it can be a really effective way to make a big gift to a charitable organization, which is wonderful, and also to minimize, your taxes overall. So this is just some more examples, which we don't need to exactly get into today, but again, it's talking about how, because you're getting this benefit of eliminating these additional taxes, you're only going to be allowed to cap it at 30% of your AGI. I would say, the vast majority of the time, though, clients do end up giving appreciated securities versus cash because they're nowhere near getting that close to their AGI limit. That very rarely happens, frankly. So for them, it makes more sense to give appreciated securities rather than cash. So this is something that I actually want people to focus on or really think about on this call. This may be like one of my two big like takeaway points. Is that you actually can, instead of taking an RMD from your IRA, you can redirect it to a charity. And not a lot of people know about it, frankly, but it's really important. So if you are over 70 and a half, you can essentially direct in 2025 that up to $108,000 of your otherwise required RMD can go to a charity. And this is called a qualified charitable distribution. Sometimes it's called a QCD. It has to be paid directly to the charitable organization. So it can't, go to you and then you donate it to charity. It has to go directly to the charitable organization from your IRA. It satisfies the RMD requirement, which is great, but there's no income tax on it. So this only works for IRAs themselves, doesn't work for other retirement accounts, which is a question we get a lot. Right now it's only for IRAs, but it's really easy. Like if you're not otherwise needing the money, it can be a limited amount that you're giving away, but it's money that you weren't really, if you're not dependent on your RMDs, like it's just a nice way to divert money to charity and kind of in the immediate, where you don't miss it. It's just money that goes right to the charity. And not many people know about it, but the people who do know about it generally will do it every year, which is a really nice thing to do. You are capped at the $108,000, but for most people, they're not getting $108,000 RMDs out of their retirement accounts every year. I'm just going to take a little bit of time to talk about some more complex lifetime sort of estate planning vehicles for charity, but We're not going to spend a lot of time on this. It's mostly just so that you understand kind of what they are and what the options are. Um, so the first is charitable remainder unit trusts. So they're called CRUTs. To do a CRUT, you need an attorney. Like some things I will say, oh, maybe you could print something off the internet. For a CRUT, absolutely, absolutely not. You need a lawyer to help you with this. And how these work is that you're the donor, you give money to the CRUT. The CRUT pays you a specific percentage every year. And it's called a CRUT because it's a unit trust. And when they talk about unit trust, they're talking about the percentage. And it can be for a specified amount of years, it can be for a lifetime. And then at the death of the donor, so if you're the donor, you give this money, the balance, whatever's left over, goes to charity. And you get an immediate upfront charitable deduction based on the present value of what's going to charity at the end. So sometimes this can be like a very effective way to sort of put money into a charitable vehicle, but still retain some financial interest in it and get a good charitable deduction. Again, sort of we talk about what to give to these CRUTs. Appreciated securities are great because they eliminate the taxes that you otherwise would need to pay. So long-term capital gains and the NIT. So sometimes for people who are incredibly wealthy but have incredibly high or low basis, I guess, high appreciation in securities, this is something that we think about doing for them. Maybe we do like 5 or 6 of these a year, so not a huge number, but enough that we think about it for our clients for sure. So sort of I like to call them twins. I know that Jess has twins, so I had to bring twins up. Our charitable remainder annuity trusts. So again, this is something that you should set up with the assistance of an attorney. And these are called CRATs. And CRATs are different from CRUTs in that you get a specific amount of money a year. So you can say, I want an income stream of $100,000 a year out of this trust for a specific amount of time. And they're not very common, but they're good if you're an older person who wants to know exactly how much is going to be left for you or every year until like the rest of your life or for 10 years. For financial planning and sometimes even for like emotional reasons, you need to know what that number is. Like these are a better option. And again, like you get the immediate charitable deduction based on the present value of the assets that are passing to charity. But these are very, I would say, relatively uncommon. And again, the same thing, people who have a lot of appreciated securities, like this is often a good option for them. So just one really sort of important thing when we're talking about doing lifetime planning or doing lifetime transfers is mitigating the estate tax. That's really a crucial part of planning. And, the reason that we focus so much on this is that using up your assets now can really help mitigate the estate tax later. So even small things like giving those $19,000 to your kids, maybe putting some money into a trust so it can grow outside of the tax system, small beans now, small potatoes now can have a really big impact later. So, the exemptions are really high. So if you can afford it, what we generally are telling clients is you should really think about giving away a lot of money now. The exemptions are high. If you're younger, especially, over time, that money can grow exponentially and it'll all grow outside of your taxable estate. And if you have sort of assets, I'll call them interesting assets. I'm not sure everyone would feel that way. But if you have interests in things like family businesses or other things that can be fractionalized, there are certain techniques that you can use to really turbocharge the planning. Do a family business, the family business is worth $1 million. Half of it is not worth $500,000 because nobody would pay $500,000 for half of a business that was in the aggregate only worth $1 million. Maybe they would pay $300,000. So we can, if you fractionalize the asset, if you take 50% of the company, you put it in a trust, for example, it can grow outside of the estate tax system, having used less of your exemptions. We can do other things, like when we set up trusts, we almost always make them something called grantor trusts, which means that the trust, the settlor, so the person who set up the trust and gave away the money, they are paying the income tax on the trust for life. So if I set up a trust for my son, it has $1 million in it, and I said, okay, well, I'll absorb the tax burden during my lifetime, over time, that can really be an enormous amount of money. It's essentially a tax-free gift that you're making to the trust every year. So lifetime planning is really important in terms of like long-term mitigating the estate tax. I just wanted to mention this because, again, like this is a really, really important thing in terms of lifetime planning, is planning for incapacity. Again, this is something that people think will never happen to me. And these are sort of 3 really important things to think about when you're doing estate planning. So besides your will, which is crucially important when you die, we also want there to be documents in place that if something happens to you when you're alive, but you're incapacitated in some way, that somebody can act on your behalf. So the 3 main documents are an asset management power of attorney, healthcare power of attorney, and we call it a declaration of intention. Sometimes we call that a living will. So for an asset management power of attorney, that allows somebody to make financial decisions for you and transact on your accounts while you're alive. And people think, well, I wouldn't want anyone to do that. Why would I want someone to do that? And the answer is that if you're hit by a bus, you're in a coma, you want to be able to pay bills out of your accounts. And if you don't have a power of attorney in place, you have to go to court in order to get somebody to have guardianship over you, who then can access your accounts on your behalf. So it gets incredibly expensive very quickly, and it's very difficult if the family is already going through a very hard time to go to court to get this guardianship established. And frankly, that's just not something that's top of mind for people until they need to pay a bill, and then it becomes a real emergency. Like, I can't pay my bills, we can't pay the mortgage because all this money is locked up and I can't access it. So asset management powers of attorney, people often are reluctant to sign them because they don't want to give someone basically power over their financial accounts, but it's really important that people do have one. Pennsylvania has a special statutory form. So if you are getting one from the internet, just remember that Pennsylvania has specific requirements. If the power of attorney does not comply with those requirements, no bank will accept it. So be very careful about, what form you use. We suggest that you use an attorney for a power of attorney for this. But we would suggest too that when you look at it, if the agent isn't signing it, it's not a valid power of attorney in Pennsylvania. In Pennsylvania, the agent has to sign it. Their signature has to be on it too. So just be careful about that. For healthcare, durable powers of attorney, that's really in the event that you've been hit by a car and somebody needs to make a serious medical decision. Who do you want to make that medical decision on your behalf? And I would say for almost all of these, just to say it, it's the spouse followed by the kids. And generally people don't want to put one kid in charge of these decisions. They put both, just so that one kid doesn't have the burden of making, for example, a serious medical decision. And the other one doesn't have that burden. For the asset management powers of attorney, it's slightly different, where people will generally also choose their spouse and then they name the kid that's nearby. So it doesn't make sense to name somebody who's an asset management power of attorney, like agent for you, who lives in like California. It just doesn't make sense. So people will say, okay, well, this kid is local, let me name this kid. And then the other child can be the backup in case, the first kid and the parents are in an accident together. The third one is the declaration of intention. And that basically says that in the event that I'm being kept alive by machines, that's not what I want. So sometimes people don't want a declaration of intention. They want to be kept alive by machines, but I would say 95% of people, that's not what they want. And it makes it easier for the family if there's a declaration of intention in place where somebody proactively says, this isn't what I want, because then the family doesn't feel like, oh, well, if they were alive, they would have wanted me to do everything possible. They would have wanted to keep me on a machine for years and years. It's nice to be able to have that document and say, no, like that's not what I want for myself. And then you can always feel like if you're the spouse or the child, like this isn't what this person wanted. And it gives people a real sense of comfort that they've made the right decision when they're in that place where they have to take somebody off of life support. So lastly, we're going to be talking a little bit about charitable giving and estate planning at death. So we're going to go over this quickly, and then we're going to talk a little bit about charitable planning at death, but not too much. This next slide is actually my favorite slide, and I think the most important slide. So I just wanted to quickly go over, what Morgan Lewis considers the optimal plan. Understanding that every family structure is different, people are different, they want different things. And your estate plan, of course, should always reflect, what you want to happen at your death. But this slide, we're just going to start at the top left-hand corner. And we always assume that the husband dies first. And always my male clients find this very offensive. Like, I'm not going to die first. And I just tell them like that these are statistically, you are going to die first, barring like some special situations. And so we're just going to presume for purpose of the presentation that you're going to die first. So first, we talked about this before, like wills only govern individually owned property. So the extent that you have beneficiary designation assets, we call them, like those go directly to the beneficiary. They don't pass pursuant to the will. But if they do pass pursuant to the will, they go into the will. And in Pennsylvania, like what we like to use is something called a pour over will and a revocable trust. And a revocable trust is essentially like a will replacement. And people say, well, why do I have that? I don't really want that. That seems overly complicated. And the main reason is that wills are public in Pennsylvania. So you can actually go down to the courthouse and pull out people's wills. You can't do that for revocable trusts. Revocable trusts are private. So we have, a will will say, it's very short, it's called pour over will. All my assets pour into my revocable trust. My spouse is my executor. That's all the information that they have. In the revocable trust, they say, I'm cutting out this child because they're a horrible person. I want to give $3 million to this charity. I have a child that I never told anyone about, and that child's getting $10 million. Like that's kind of where all the magic happens, is in the revocable trust. And it's just nice to have it be private. And what we consider the ideal structure is something called a residuary marital trust structure. Sometimes it's called a credit shelter trust, it's called an AB trust. It has like a lot of different names. But basically what happens in that scenario is that there's a residuary trust that's formed first, which is very confusing. And that's funded with the amount that can pass pursuant to or free from the estate tax. And the remainder goes into a marital trust. And the effect of having this structure is that you completely defer federal estate tax until the second death, which is what most people would like to do. They want to avoid the federal estate tax as long as possible. So in this, under current planning, for example, if you died, you were married, you had $14.99 million in your own name, the residuary trust would get 13.99. The marital trust would get $1 million. Then the death of the survivor, it splits into trust for the kids. Generally, people who do charitable planning like to do it at the second death. So you can see that at the top of the right hand of the screen. Charitable giving, especially from retirement accounts, it's really popular. So like naming your spouse first on a retirement account, followed by a charitable organization, is something that is very common and is great because you can ensure that your spouse has enough money, but then charity gets it at the end. And the wife's plan in this example is just going straight to the kids because there is no opportunity to defer the estate tax at that point. So just to go really, really quickly through some of these additional slides, because I am almost out of time, but just some common things. So outright bequests, giving money to organizations at death is very common. It's not subject to the estate or inheritance tax. So I give $20,000 to ECS, just as an example. Another common thing that we see are charitable lead annuity trusts. These are assets that you leave at your death to something called a charitable annuity trust or a CLAT. For a certain period of time, assets go to charity, the estate gets a deduction, and then after the period of time is over, and the maximum you can do them is 20 years, the assets go to non-charitable beneficiaries. And it's possible to create a zero tax estate plan using a CLAT. So people find that compelling sometimes. You can also do something called CLUTs, charitable lead unit trusts. And those are where the money goes during the term to 501(c)(3)s. But again, it's a little bit, it works slightly differently in how the payments are made during the term to the organization and to the beneficiaries. And lastly, this is just a little slide on me. In case you have any questions, please always feel free to give me a call. And with that, I will pass it back to Jess.
So Emily, I know we said we probably wouldn't have time for questions, but I think there's at least one, maybe two questions here that are really quick. Do you mind?
No, I don't mind.
Okay, so this one's from Mike Schaefer. He says, for people that live in PA, does the PA inheritance tax apply to inheritances received from people outside of PA?
It does. That's a great question. Yes.
And then Angelica Grace asked, going back to the beginning of the slides where we were talking about $19,000 for federal tax exclusions, $19,000 to your kid in January, best practice. She asks, is this the same in each state?
Yes. So that's a federal exclusion. So it's the same in every state. And no states, I think, impose a gift tax anymore, except for the possible exception of Rhode Island or Connecticut. I think one of them still does at very high levels, but all other states don't have a gift tax.
Great, that's really helpful.
Yeah.
There were some more questions, but I'd probably be on this discussion today, so I think we should try to wrap it up.
Sure.
On behalf of Episcopal Community Services, I want to extend a thank you to you, Emily, for sharing your expertise and valuable insights.
Of course, absolutely. Yeah. It's just an honor to be part of such a great organization. I think too, people are just really struggling right now to kind of find an organization to give back to. The world seems very topsy-turvy. And I know that you guys do a lot of amazing work right in our community, and everyone appreciates everything that you guys do.
Well, I 100% agree with you there. At ECS, we envision a world where the path to prosperity is available to all, and charitable giving plays a vital role in making that possible. Legacy gifts are a powerful way to create lasting change. And if today's discussion inspired you to think about causes you care about, we hope you'll consider ECS as part of your plans. On that note, I'd like to share an exciting opportunity. Beginning in March, we will launch the ECS Legacy Challenge. This is a special initiative to encourage thoughtful charitable giving. If you inform us of a legacy gift to ECS in 2025, a group of trustees on our board will make a $1,000 donation in celebration of your commitment. Keep an eye out for more details in our follow-up email. And before we close, I want to invite you to our next webinar where we will explore the power of EITC giving. That's Educational Improvement Tax Credit Giving, where it costs a dime to give $1. That's right, it costs virtually nothing to make a gift when you redirect your Pennsylvania state tax payment to an approved charity. ECS is an approved charity, and we will be sharing more details about that webinar in the coming months. We hope you will join us. Thank you again for spending time with us, and have a wonderful rest of your day.